Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Abhijit Gang, Managing Director at Goodyear Ventures. Abhijit, could you take a few minutes to share your story and how you got to where you are today?
Sure, sounds good, Nicola. Thank you so much for having me on this session. Super excited to be here and be able to share some of our journey and where it all started and where we are so far and where we are trying to go. So in terms of my own personal journey, by education, I'm an engineer and an MBA. And I spent pretty much all my career in growth initiatives for companies. So supporting revenue generating activities in new markets and new businesses. My Goodyear journey started almost a decade ago today, actually. And I've spent a majority of our time, in fact, all of my time, in our R&D groups, managing and supporting and building up some of our corporate incubator and its related activities. It's been really great to be exposed to Goodyear's global business units, understand some of their priorities, and design new initiatives that add value to the corporation in that way. So we had some failures and a few successes, and very proud of the ones that made it through to some of our business units and got scaled up inside those business units. As a part of doing corporate venturing, as a part of doing our corporate incubator, we also regularly interacted with startups and we worked with some of them. We even ended up buying outright a company that fit our strategic needs very closely. All through our incubator activities, as well as some of our own internal reflections on how to accelerate some of the initiatives that we wanted to get to. Creating and setting up a corporate venture fund was always seen as an important initiative. We felt collectively that by doing so, we would accelerate our own understanding of the rapidly changing mobility ecosystem that we are facing today. So in 2020, January, the CVC was actually set up and it was announced in CES in Las Vegas, one of the last few in-person events that we had before the pandemic shut the world down effectively. And I took over the leadership role of the CVC in March of last year. So it's been unique because this CVC, for a majority of its lifetime, in fact, almost all of its lifetime, has been spent inside the pandemic. So we have found ways to work in those challenging circumstances. But that's roughly a little bit about my journey and how we came to do the corporate venture and how it got started.
Very nice. Thank you, Abhijit. So you mentioned CES. So I remember, and I'm very grateful to Goodyear when you launched to invite me with my friend Sagi to the blip flying over all of CES. So thank you for that.
Yeah, it's an iconic symbol of Goodyear and our brand, and it's one of the coolest thing ever to be inside a blimp. So very happy that you got the opportunity.
Oh, it was very cool, very cool. It feels like you're on a lounge in the sky. Maybe it's not the same experience as what Jeff Bezos just did, but it's not bad. So there's a lot to unpack what you just said, but maybe very high level. You're looking at investing in mobility space. What's the size of your fund and how many investments do you think you're going to make with that fund?
Yeah, it is a mobility focused fund. The overall fund size is $100 million. We are a follow-on investor, which means that we like to look for a consortium of investors who are like-minded, who are trying to roughly achieve the same things that we are, and appreciate what Goodyear brings uniquely into an investment consortium. And then we participate in the investment round as a follow-on investor. That's been our philosophy of investment so far. We don't have a hard number of investments we have to do or need to do in a given year. We have done so far 6 investments. 3 of them are public, 3 of them are not yet public. Hopefully that'll be made public very soon. But most of our focus has been on the electrification trends, which are very much deeply taking root in our industry or have taken root and are now accelerating. We have also focused on autonomous vehicles, more specifically on the use cases which are coming to fruition and to the market first. So we have made investments in that area. We are also deeply interested in the connected ecosystem. It is a very unique product that we bring into the market with respect to our core product, which is the tires. We don't think of tires on a daily basis, but it is unique because the tire is the only part of the car that touches the road. And when you talk about automated vehicles or autonomous driving profiles, in a tactile way, what the tire senses from the road can make the autonomous driving profiles very much safer and more efficient. So we believe in those dimensions of value add that we have. And those are the things that we bring into some of the investments that we make.
Can you describe maybe in 30 seconds or 1 minute, what is your mission as a corporate VC?
Yeah, it's been an interesting part of my job to also communicate to our corporation what is the purpose of setting up an investment like ours. I would say, in a very brief manner, the pace of change in the mobility ecosystem in the last decade has been breathtaking. And that change, that it's a really big opportunity if you can keep up with that ecosystem and its pace, to learn from it and then adapt your future strategy on the basis of what you're learning. And we felt that we had very strong R&D programs and capabilities and technical programs, and we have a lot of great relationships in the marketplace with respect to the traditional OEMs and the existing and the new up-and-comers, and we are learning a lot very quickly through all of that activity. But I think the real reason why we set up the Corporate Venture Capital Fund was to add an extra dimension to how we learned and bring in that external perspectives from founders, from entrepreneurs, who were pushing the boundaries of learning in the mobility ecosystem, and bring that in a more direct way than was ever possible. So that was the mission of setting up the CVC fund, to accelerate our own understanding and learning of the changes that are happening to the ecosystem that we care about more deeply. So really that's the purpose. So we choose our investments very carefully in terms of, are they operating in a space that are today or will be in the future very relevant to us? And if that answer is yes, then the second question is obviously, how can we create value for them in their own journey? But the mission remains the same: to learn, to explore, and to keep up with, as I say, is the breathtaking pace of change that is happening in the ecosystem in mobility as we look at it today.
In your case, you started with an incubator and then a corporate VC. What do you think of the two paths? If you could choose, which one would you choose?
That's a hard question to answer. I believe it's very situational for each company. In our case, it became very important that we are able to explore in addition to running our own business on a day-to-day basis. Yes, you have to make sure that the business is running and the mothership is operating. That's important. But while doing that, it was hard for us to dedicate time and attention and resources into some of those more exploratory activities. That's what led us to start the corporate incubator and the corporate innovation program that fed into that incubator. So that was our journey. Now, at that time, it wasn't evident to us that the CVC should be the first thing to do, but it was very evident to us that the incubator should be done because the exploration activities was better done in that kind of a setup. As we started the exploration activities, then we asked ourselves the question as to how to take this level further. And that's how the CVC conversation came into being. But I can completely see the other way around, where you can argue that, look, let's have the CVC set up first. And when we understand the world outside, we will know how to set up the incubator better. And I think that there is an argument to do both. But in our case, it first started with an understanding that we needed to focus time and effort and resources and even metrics and measurement systems separately from our core business and put them in that kind of an incubator setup. At the same time, the incubator was very closely linked to some of our core assets because the Goodyear brand, the Goodyear retail networks, our technology elements, all those things were leveraged by the incubator. So it was not a rogue operation by itself. It was very tightly linked to some of the core assets that Goodyear could bring to bear. But in our journey, that was the first element, and the CVC was added on last year as we speak.
Talk to me about your investment thesis. Clearly, you said you're mobility focused. Clearly, you want to add value to the companies through Goodyear. But what's your investment thesis? What are you going to invest on this bet on the future as you talked about?
So we are not so different from other mobility-focused funds in terms of areas we are looking into. For example, obviously, electrification is a very big opportunity for us going forward. And that's an area that we are looking into with respect to investment and thesis. The way we are different is what exactly is it that we are investing in within those dimensions. So with respect to Goodyear, there are two key angles to our investment areas with respect to electrification. One is understanding the way our products need to change or to adapt to the electrification trends, and also understand the way our services and solutions need to change to adapt to the trends of electrification. Many people may not realize this, but Goodyear is not just a tire company. We have a substantial presence in retail and services and solutions. And in many instances, we serve customers like FedEx, some of these national carriers. We service them in addition to supplying the product for them. And those services can be sometimes IoT and data enabled through sensors that go inside the tires, or our infrastructure-based sensors that can sense the condition of the product we're offering. So a lot of that stuff has to evolve with the electrification because the basic vehicle and its configurations are changing. So we are very interested in understanding how services, how solutions evolve in the electrification world, how we can support our customers electrify from internal combustion engines. So those aspects of our thesis are a bit unique with what a generalist mobility fund would be doing. So that's how we are focusing on the EV world. On the autonomous world, there is a very clear case for tire companies or companies that are building that touch point of the car with the road to inform the autonomous software stack in terms of what the tire is sensing, what the tire is feeling, connected to different third-party data sources, weather or a road condition, etc., and being able to make that autonomous stack more efficient, more safe when it's driving. Imagine an autonomous vehicle that is driving on completely worn out tires, following an autonomous vehicle that's driving on a completely new set of tires on an icy, slippery surface. The braking distances of those two vehicles would be materially different. Yeah. And these are the instances where we think we can come in and make a lot of difference as a strategic partner, in addition to being an investor. So that's been our thesis in the AV landscape. We are obviously interested in connectivity because as it relates to the car and its ability to connect to tier one components, the tire is an important enabler of many value propositions when it's actually connected, not just to the car, but also to the chassis control systems that operate that actuates different safety and other aspects of the car, like electronic stability control systems. So those have been areas of technology that we are looking into deeply and we'll continue to look into. And of course, there are other trends. For instance, mobility is becoming multidimensional. You just don't move in the map in a two-dimensional way, but mobility is moving up. So there are so many dimensions of mobility now, not just moving on the x-axis or on the y-axis on a map. You can go tunnel down in the earth and move that way, or you can go up in the flight in the eVTOLs and move that way. And there are short-haul movements in how much of ground transportation is going to be in the air in the next 15 years is a very important question for us. And we want to learn about that. So we're interested in that, in those dimensions as well. So those are some of the elements and some of the theses around which we are looking. And each area is really designed to help us learn and experiment and gain an understanding of how fast are things happening, how fast are things changing in the mobility ecosystem.
It's very interesting. And one thing you're saying, which makes me think about business models. And the business model of Goodyear is really based on value per miles. And as you drive more miles, clearly your product needs to be replaced or you need higher performance. And if you think about autonomous driving, this is a transition back to this model per miles where you could be renting. So I can see how you're going to need to learn more also on supply chain and business models. Can you talk about your investment committee? How did you set it up? What do you think are the best practices you learned from others that you would want the audience to consider?
Yeah, so our investment committee has our C-suite executives, our CTO, our CFO, and our CEO. In addition to that, we have some critical touch points into the business as well with respect to legal and some of the overall R&D leadership that we have that is managing the incubators as well as the CVC. The best practice in putting together an IC is to have people who are able to, of course, support and champion and help the corporate venture capital fund gain toehold in the company in its early days. So it has to be at a very high level. It needs to be at a very high level in the company. So that's an important piece. And secondly, it has to be filled with people who are leaning forward and asking critical questions about the business and its future and what are the key things that we need to learn. So it's important to understand who are the right people that would help the CVC and create the investment committee in that way. And also sometimes you will need support from within the corporation to be able to execute on certain things. So to be able to have that high level visibility and to be able to go to these people and ask for support in certain areas is critical. So that's another additional consideration that you would need. But in my case, I'm very fortunate to have an IC that is oriented towards the future and is allowing and enabling the CVC to make these investments. As an example, the first IC I had was immediately around the quarter where we were reporting results after COVID impacted everything. And it never came into the conversation of that IC. They were always focused on the future. So this ability to decouple from the day-to-day and being able to bring futuristic mindset into the meeting is the most important thing, I feel, that CVC investment committee has to bring. It's almost a very different wine that you're tasting, and you need that cheese in the middle, right, to cleanse your palate a little bit. So it's a little bit in that way analogous that you have to bring the group in with a different mindset, with an approach towards being curious towards the future and focusing on what we can learn from this deal. And for the time being, decoupling from the day-to-days of the existing business, which is important, but in that context is probably less relevant. So yeah, in Goodyear, we have phenomenal IC, and they've operated and supported the CVC vocally. And we have been able to find our feet in some of the most difficult times inside the corporation and do some great work. I remain very grateful to the committee and the way it has supported the CVC unequivocally.
I think there are a few golden nuggets, but I like the way I describe it is you have a loose connection. You're not tightly connected to the business that you would be impacted when the business is challenged. You mentioned you have 3 CTO, CFO, and CEO. Do you need the majority, or do you need all of them to agree to make an investment?
Yeah, so just to clarify, we have a senior director who manages the corporate innovation and the incubators and the CVC in there, and also our chief legal person in the team, which is very helpful because they're able to give you fast guidance on some of the watchouts and pitfalls. So I wanted to make sure that I acknowledge their roles that they play in that committee. We don't often have a vote. It is usually by consensus. And I have seen that almost every single investment recommendation we have made had been passed unanimously. Nicola, I don't know what a voting process would look like, but we haven't set it up like that. If someone brings up a concern, we examine it from all different angles. So the way we have it is agreement through consensus. But if somebody brings up a concern that, hey, have you looked at that angle or have you investigated that line of thought? We don't usually resort to a voting process. We want to make sure that we address the concern if it's brought up. And if it's something that the CVC missed in its diligence and we then revise and change the decision, we will do so. So that's the culture in which we operate. It works best for us. But in a different setting, a voting process might work better.
Maybe one question is, startups do pivot. Let's assume that you invested in a company and they pivot into something which is no longer strategic for you, but financially they are a rocket. They are really doing well, and maybe thanks to the pivot. Would you not follow on because of no longer strategic alignment, or would you follow because actually the financial makes sense?
If the financials make sense, I would still go to my IC and defend a follow-on, because as I said, the financial return goals that I have on my performance targets are not fictitious. They're not made up. They're real. So of course, if we have a pre-existing relationship with a startup and they pivoted and they're a little bit too much far away from where our strategies and our interests lie, but we see them to be a continuing success, financially speaking, we wouldn't just turn off that as an opportunity for our IC to review and approve, because the financial goals are still relevant. And even when a startup is pivoting and it's going to do something different, in that big aspect, there is also a lot of lessons to be learned for our internal initiatives. So I think pivot is not necessarily a bad thing, even if it happens away from your strategy. It can be very instructive for our own incubators in terms of how to actually pivot and make something very different work from something that you started with originally. So it can be an inspiration sometimes. I wouldn't completely discount it, even if it is a little bit further away from our strategies.
I think you mentioned that you bought one of your own startup. How do you quantify the value that you brought to Goodyear through that one acquisition? How do you measure it?
Yeah, so it is not typical for us to buy the startups. We recognize that in most occasions, the best outcome is to leave the startup's DNA to itself and let it mature on its own and allow us to be a part of the ride and learn from them. In this specific instance, the strategic fit was so high that we determined that the startup would be better off inside Goodyear than as an independent company. So that's why we made that strategic decision. And it was actually an electronics company that was really great in building sensing technologies, which was relevant for our core product. The way we justified the return on the investment and the strategic rationale of buying or making that acquisition was the level of intimacy it gave us with our customers. Because now we are connecting with our customers, not just by giving them a product or giving them a manual service. There was a lot of automated aspects of delivering that service to our customers. So it connected us to our big customers in a very meaningfully different way. And that's mainly how we justified that specific acquisition. But I want to specify, we typically, from the CVC, certainly, we don't typically look for acquisitions as an end goal. We look for the startup being successful on its own as an end goal, and we being an enabler of that success.
That's a perfect way to look at it. You see so many startups, some you will invest in, some you won't, but it could be beneficial for Goodyear, for the mothership. Can you talk about examples where you meet startups and you're like, you're not quite for our investment, but we want to engage with you and we will connect you with Goodyear?
We actually met a startup which was building a very unique and innovative platform on different types of electric and autonomous vehicles combined together. They typically fell within our world, tier one type of a company, an original equipment supplier. Not very deeply connected with our thesis, but we realized that because of the way they were designing the chassis and the systems, that it would make it a very interesting candidate for us to bring in our product development engineers to work with that startup to examine if we could build a very different product that fit that application. So that was a case where we said, you know what, it doesn't fit our thesis and we are likely not going to be an investor, but boy, we could learn so much by working with you strategically. And lo and behold, we have a memorandum of understanding with that startup to support it in product design. And again, to support it in the aftermarket with respect to solutions through and services through the Goodyear store. So those examples are, in certain cases, the CVC does not hand off the relationship. We have tended to follow on and execute the MOU on behalf of the organization and then hand it off to the concerned person with respect to the technology development work that will be doing that work. So those are terrific side benefits of having a CVC. Sometimes those benefits can overshadow the direct benefits of having the CVC itself, because these are such meaningful innovation that's happening that concerns our product, and we can make those connections happen even when there is not a direct investment possible because of a gap in the thesis.
Abhijit, I think it's a great way to finish this really nice interview and showing that you bring value to Goodyear even when you don't invest. Thank you for your time. It was really nice.
Thank you, Nicola. And thank you everyone for having me.